In this video, let's review SPMO ETF, which is a fund that uses momentum factor for its returns. SPMO fascinated many investors, and according to some YouTubers, it broke the stock market. It even eclipsed, in terms of returns, other growth funds like QQQ, SCHG, and even VGT. Before we proceed diving into SPMO, I want to talk about momentum factor investing. After all, this is the strategy that underpins this fund. Factor investing is an asset portfolio based on a specific driver for returns. Typical factors in investing are value growth, size, quality, and momentum, among others. For instance, let's take quality. If you want to pursue quality factor investing, you would select stocks based on high profitability, financial leverage, as well as stability of earnings. And likewise, there's a momentum. If you want to assemble stocks based on momentum factor, you would go by past price appreciation of a given stock relative to its peers. For instance, Nvidia showed 12-month price appreciation of over 50%. In contrast, we have Adobe stock, which declined by over 30%. There are some nuances to calculating these returns that I will cover shortly. But for now, let's keep it simple. So you would assemble returns of all relevant stocks and rank them from worst to best. A typical momentum strategy would go long on the top 20% and go short on bottom 20% stocks. That's right, there's a short lag in momentum strategy, and it is no less important. Although a long-only momentum strategy works too. I want to point out that momentum and trend following are really two different things. As we saw from before, momentum ranks securities based on their performance relative to its peers, whereas trend following, for the most part, focuses on absolute price changes. Trend followers tend to increase their exposure when there are bull markets and decrease it when there is a downswing. Conversely, momentum ranks and invests in worst and best stocks regardless of what's happening on the market. Now, there are critics saying that momentum factor is garbage. They say that it doesn't work consistently. If you hear this, that's not what data says. In fact, momentum has consistently done well in comparison to other factor investing. There's a paper titled Fact, Fiction, and Momentum Investing that I link below. It goes over and busts some of these myths surrounding momentum. The authors show that over the long term, momentum beats other factor-based portfolios. Among them are size and value. That was true even on a volatility-adjusted basis. Now, the natural question is why momentum works? And there's no clear-cut answer, only speculation. And either way, there are two possible explanations behind it. One has to do with investors' behavior. It says that momentum is a delayed reaction to either positive or negative news. The information travels slowly and stock prices don't reflect it right away. Maybe investors are too conservative or inattentive. Either way, as information proliferates, prices start to reflect it better over time. Hence, momentum captures that better reflection of information. And by the way, this behavioral theory is counter to efficient market hypothesis, meaning that the stock prices reflect public information efficiently and all the time. So there's a debate there. The other explanation behind momentum premium is that it's just a compensation for risk. The momentum stocks tend to show higher cash flow risk. So when you invest in these stocks, you pretty much demand higher return for accepting that risk. Either way, regardless of which theory is right, momentum works, and its outsized returns are there and show no signs of disappearing in data. Now, momentum has documented risks and costs. Because it doesn't last for too long, it requires trading frequently. Portfolio turnover can be material in the realm of 50 to 70%. That can lead to more trading costs that are separate from SPMO expense ratio. Of course, if momentum generates above average returns, who cares? Another more serious risk to momentum is its vulnerability to sudden crashes. And compared to some other factors like value, these sudden crashes happen more often. And they usually happen after a bear market, especially a prolonged one, that is followed by upswings. When we look into SPMO total returns, I will highlight this one episode that happened in 2022 and 23, and I will discuss in more great detail what really happened there. Now let's examine SPMO and how it constructs its momentum portfolio. SPMO starts with the S&P 500 stocks. So by design, SPMO will consist of some of the largest market cap US equities. Next, fund ranks stocks based on their momentum score. The momentum score is based on the 12-month price change, excluding the most recent month. It's a standard procedure for momentum factor investing to exclude the last month. The reason has to do with documented price reversals that usually happen in the last month. These reversals can interfere and make returns from momentum worse. Furthermore, the derived momentum value is adjusted by the stock's standard deviation. This adjustment gives higher scores to lower volatility stocks. That's a very sensible approach. Higher volatility episodes can signal worse outcomes ahead for momentum strategy. After that, there are a few standard statistical procedures. SPMO ranks stocks based on their momentum value score, and then it invests in stocks that land in the top 20%. Note here that SPMO is a long-only momentum strategy. It doesn't short stocks like what the standard momentum factor investing does. The fund weighs its holdings by each stock market cap and momentum score. In other words, stocks with higher momentum receive higher weight. That's a logical approach too. At the end, SPMO usually holds 100 stocks. Another thing I want to point out is that the fund rebalances and reconstitutes every 6 months. Frequent reconstitution for momentum strategies is very important. Stocks that show great momentum today may be very different in a matter of months. In fact, I looked at some other momentum ETFs and I saw that some of them actually rebalance and reconstitute every month. Data shows that momentum tends to die down in about 6 months. So it's understandable why SPMO chose this time frame for reconstitution. Also, portfolio turnover was another factor this ETF's management had in mind. It is already high as it is with 6 months of reconstitution. With every month reconstitution, it would have been 100%. That's a lot of trading cost right there. Top 10 exposure can be very heavy for this fund. This depends on what's gaining momentum at a given time. As for sector allocations, this is what we see. I would not view these allocations as set in stone. In fact, they can shift a lot for this fund, as we'll see in a second. Now let's examine SPMO's total returns in comparison to, say, QQQ and SCHG. QQQ and SCHG are large growth funds. But what about SPMO? It tends to fluctuate a lot between large growth and large blend categories. This depends on where the momentum dart lands. For this reason, SPMO is not exactly a perfect replacement for growth in your portfolio. It sort of has its own unique place. Now, the first observation here is that since its inception, SPMO has not done much better than SCHG or QQQ. As we see, there were periods of underperformance too. Here's the thing. Different factors shine at different times in their returns. Sometimes value or growth dominates. Sometimes it's momentum. For instance, here's a chart from Morningstar. It shows how different styles rotate each year depending on their performance. From 2014 to 2024, Momentum Factor Index claimed top spot in 6 different years, but it was close to the bottom during the other 3. In 2025, momentum seems to shine again. If we zoom in, SPMO beat both QQQ and SCHG lately. This outperformance against the growth factor is very material. I don't know if this will persist into the future. If history rhymes, it may not. So take these massive recent returns with a grain of salt. Next, I want to zoom in on 2022-2023 and explain what's happening there. As you may know, 2022 was not a good year for tech and growth stocks generally. Inflation, rising rates, and fears of recession caused sharp drops. Nasdaq 100 alone declined by 35% from its peak in 2021. If we look at sector allocations back in 2022, here's what we see. SPMO entered 2022 with large allocations to financial, communication, and industrial stocks. Financial stocks staged a massive rally back then on the back of rising interest rates. Note how SPMO also had 18% allocation to Alphabet in the communication sector, but all other stocks allocations, especially in the technology sector, were nothing to write about. In fact, if we look at the top 50% list, we see a lot of value names there. That saved SPMO throughout 2022. Having less allocation to many large growth names like Meta or Nvidia helped. If you recall, Nvidia declined by over 60% back then. Meta dropped by over 70% from its peak. So avoidance of these large names turned out to be prudent for the fund. While QQQ and SCHG dropped like rocks, SPMO held up well. But when recovery began in 2023, SPMO was not well positioned for that. Because growth stocks were down back then, the fund screened them out. There was zero upward momentum for Nvidia or Meta based on historical prices. In fact, if SPMO were a true momentum fund, it would have shorted Nvidia or Meta back then. That would have been disastrous in 2023. If we look at SPMO allocations in 2023, here's what we see. Most of its exposure sat in energy, healthcare, consumer defensive and financial sectors. If we look at the fund's top 50% allocations, it looks as far from growth as it can be. So no wonder when growth stocks took off in 2023, it took almost a year for them to pop up on SPMO's radar. Eventually they did. In 2024, SPMO flipped and looked like a growth fund again. A lot of its allocations sat in technology and other large-cap growth names. There are several lessons to learn here. First, SPMO is not a perfect substitute for growth in your portfolio. At times, SPMO may look like a large growth fund with concentration in big growth names, but sometimes it does not. For instance, Morningstar tracks the style of a given fund between value and growth. We see that SPMO jumped a lot from value to growth. There's nothing wrong with that. That's by design of a momentum strategy and how it behaves. But there's a second lesson hiding here. Momentum strategies like SPMO can lag the market after a bear market. This is especially true when sharp market upswings follow. This is what we observed in 2022 or 2023. In fact, momentum strategies can even crash and enter a prolonged period of underperformance. And the explanation behind it is kind of intuitive. As we saw from before, SPMO exited many high volatility, high beta stocks in 2022 as they started declining. Instead, the fund went long on low volatility, low growth, kind of like a value stocks back then. Among them were stocks in energy, consumer defensive, as well as healthcare. But when the market recovery ensued, SPMO was kind of like left holding the bag and was behind. But the good news is that momentum strategy tends to harness the better performance of high volatility, high growth stocks at some point. It's just with a delayed response after a prolonged slump. As I pointed out, the fund's returns would have been much worse if it had also that short lag of the momentum investment strategy. Shorting those high beta, high growth stocks as they were recovering back in 2023 would not be very good for its results. Economists proposed various techniques to mitigate the crashes of momentum strategies like SPMO, and some of them go by volatility. For instance, if volatility of a momentum strategy picks up, you should be reducing your exposure to it. But again, this goes beyond the scope of this video. Most investors look at SPMO as a buy and hold option. As a buy and hold investment, SPMO did very well on a volatility adjusted basis since its inception. It did better than QQQ and SCHG. Last year was exceptional, to say the least. Momentum strategy funds like SPMO can be a solid addition in a diversified portfolio, because we know that momentum works. But don't look at SPMO as a perfect substitute for your growth exposure in your portfolio. I guess that's the main lesson from today. I hope this video was helpful and it clarified for you what SPMO does and does not. Like and subscribe for more insightful content on investing in the future. I will see you next time. All the best.